It doesn't matter if you're trading for a prop firm or with your own money, you still have to know what are the chances that you blow up the account, even if you apply your strategy perfectly. This probability of you reaching the maximum allowed loss is what's called risk of ruin. And it is extremely important that you know how to calculate this yourself, which I'm going to show you on a spreadsheet, so that you can make the necessary adjustments to minimize this risk and make it so close to zero that reaching the max loss or blowing up the account is no longer a concern as long as you can follow your trading strategy. Now, think about how important this is, because once you can verify for yourself, mathematically, that the risk of ruin is under control, you can focus all your attention on what matters most after that, which is clean execution of your trading strategy. The max loss on most prop firm accounts is usually 10% of the starting balance. But if you're trading your own money on a margin account, the theoretic max loss would be reaching the minimum margin requirements. That means the broker won't let you trade anymore unless you deposit more money. However, it's not necessary to reach this point because it's a better practice if you set a maximum loss for your personal accounts as well, also at around 10 to 20%. So for this exercise we're about to do on a spreadsheet, we're going to use a max loss of 10%. First, remember that the goal is to keep the risk of ruin under 1%, and ideally closer to zero. So how are you going to do that? You achieve this by finding the optimum risk per trade for this strategy. And by optimum, I mean how much risk will allow you to achieve your goal in a reasonable time while also maintaining the risk of ruin close to zero. Now, to better understand this, let's jump into the spreadsheet, which by the way has a link on the description so you can download it and play around with the numbers and see how it's built. What this basically does is it randomly generates a sample of 100 trades every time you update the tab. You do that by pressing F9 on your keyboard. What I think is one of the most useful things of this simulation is that it's accounting for transaction cost. I have a separate video about this, so you should watch it if you want to know how this can affect your results and why you should include it always in your backtesting and simulations. For now, all you need to know is that this is going to help you get a more accurate representation of how the strategy would perform in real life. All the simulated trades are down here if you want to take a look at them. And all these trades are generated using the numbers you input in the light blue cells. All other cells are calculations, so be careful not to edit them. You can also drag the graph down and see the risk of ruin formula that I'm using that is back here. Now, notice that the bare minimum you need to know about your strategy is what to expect in terms of risk reward and probability. From there, you set the initial capital, the max loss, and the risk per trade. Here we're going to start with 1% and run a few simulations, paying close attention to how it affects the risk of ruin, which is the number down here. We get 4%, 16%, 4%, 4, 7, 4, and so on. What you can immediately tell with the current risk is that all the simulations are above 1%, and some of them even above 10%. And that right away tells you that you have to reduce the risk per trade. Now let's try risking 0.5% per trade and see what happens. We run a few simulations and we see most of them are below 1, but still some of them have a risk of ruin higher than that. Remember that we want to keep these numbers close to zero as possible, while still being able to achieve our goals, and we're going to get into that in a moment. Let's now try with 0.25% risk per trade. And notice how the risk of ruin is now significantly closer to zero. Now it's going to be way harder to find a simulation where the risk of ruin is higher than 1. Even if we had bad luck, the strategy performed worse than expected, like for example this one, where we only got a 32% win rate instead of the 40% we were expecting. The risk of ruin still stayed very close to zero. And take a look at the percentage gain at the end of the 100 trades. It is above 10%, which is usually the profit target for scaling funded accounts and passing evaluations. This example clearly shows you that even if you perform worse than expected, if you understand risk of ruin, you can size your trades appropriately and still reach your targets with minimum drawdown. I encourage you to try this with different types of strategies. For example, let's say you choose to use a higher probability strategy, which could give you an average win rate of 60% and a risk-reward ratio of 1.5. How does this affect risk of ruin? Does the higher win rate allow you to size differently? These are things you will have to answer for yourself. So it's good if you play around with the numbers, with different strategies, and have some practice. I really hope this is a helpful concept for you to know. It's one of the things I wish I knew early on, and it definitely would have saved me a lot of frustration. So hopefully you make good use of it and grow your trading account.